Hello, welcome back to this week's market update. Today is Monday, June 23rd, 2025, and we will jump right in. Markets appear relatively calm on this Monday morning following U.S. strikes on Iranian nuclear sites over the weekend, although sentiment could shift quickly depending on the nature and timing of any Iranian response. Recapping last week, though, equities were mostly flat as the Federal Reserve held interest rates steady as expected. As of Friday, June 20th, the S&P 500 was down about 0.15%, the Dow Jones Industrial Average about flat, and then the NASDAQ Composite up 0.2% last week. Looking at our economic news from last week, the Federal Reserve held its June meeting, keeping rates steady at a range of 4.25 to 4.5% as expected last week, extending a 6-month pause in rate cuts, as you can see here. Although recent inflation data shows progress, upside risks do exist, such as new tariffs potentially flowing through supply chains, as well as rising oil prices due to geopolitical risk in the Middle East. At the same time, labor market data is beginning to soften, as we saw last week with the increase in continuing unemployment claims. So a pretty complicated picture for the Fed to deal with here. But overall, this decision was largely as expected. The more unexpected aspect of the Fed meeting was what we'll take a look at in the next slide, the summary of economic projections. Taking a look at the Fed's summary of economic projections from this last meeting, overall the Fed is expecting a slightly slower economy than they did 3 months ago, as well as some slightly higher inflation than they thought 3 months ago as well. So looking here, you can see both the real GDP growth expectations for 2025 and 2026 were revised slightly lower, a little bit below this longer run 1.8% real GDP growth expectation here. The unemployment rate is also expected to be slightly higher than it was 3 months ago at about 4.5% for both 2025 and 2026. In this forecast here, inflation also expected to be higher, with the Fed expecting about 3% inflation by the end of the year on both a core and headline basis. And the same is true for 2026, although at a slightly lower level, still above the long run goal of 2% inflation. Lastly here, the expectation for rate cuts by year end stayed the same, with the Fed still forecasting about 50 basis points of rate cuts. However, they do expect slightly higher rates in 2026 and 2027, so that's something to take note of as well. So overall, the Fed is expecting a slightly slower economy than they did 3 months ago. I'm sure the fact that we did have negative GDP growth in the first quarter contributed to this change in forecast, but something to keep note of as we continue to monitor the economy and form views in our portfolio processes. Another weaker than expected data point from last week was the retail sales numbers, declining 0.9% in the month of May, up still about 3.3% from a year ago, modestly outpacing inflation, but we did see some pretty broad-based weakness in the month of May. Leading the decline were motor vehicles and parts, down about 4% month over month, as well as gas stations, which were down about 2% month over month. Lastly, we also saw a 0.9% drop in food services and drinking places sales. So that's pretty significant there because consumers are pulling back, at least in this 1 month, in the discretionary categories like eating out. Although we did see some offsetting of the decline month over month, we saw sales growth in furniture, clothing, and sporting goods stores. So not all bad news here. Overall, though, with the weaker than expected retail sales, this does add to a growing list of data points indicating some signs of strain from consumers. Last but not least, the leading economic index fell slightly in May, continuing to signal a slowdown and potentially a recession. Within the index, consumer expectations for business conditions dropped pretty sharply in May, followed by a sharp drop in the ISM New Orders Index as well. This was partially offset by a rebound in stocks from April sell-off from the S&P 500 index there, contributing pretty positively to the index, although it wasn't quite enough to make it a positive month for the LEI. So this continues to be a pretty bearish signal overall. It has been for many months now, but we have yet to see a full-blown recession pan out. So maybe this indicator maybe is not as accurate as it once was. We know economic data is not always stationary, so just want to keep it on our radar though as we continue to assess the US economy. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to providing another update to you very soon.